Good morning, good afternoon, and good evening, friends. We started the discussion around accounting for incomplete records, right? We discussed about all small time shopkeepers who do not normally maintain the books of accounts. And for them, the incoming cash and outgoing cash are the major priority, and they don't account for any normal transactions that happens like depreciations, wages paid, etc. It's all dealt only through cash or through bank or through check. The other accounting entries are not normally recorded, or even if it is recorded, it's recorded only one side, thinking only about the cash in mind. So the challenges what we have in accounting from incomplete records is the owner or the shopkeeper, or for that matter, any small time business as well. If they have an accounting for incomplete records, accounting with incomplete records, they tend to ignore these. So, uh, they determine profits? Profits are basically determined basis the capital what they have in the business, and what is the capital that they had at the beginning, and what is the capital that they have at the end. And even now, even this, they know that okay, the small time business or the shopkeepers, they know that they had a capital of around say 1 lakh at the beginning of the period, and now they have a capital of say 10,000. So and that determines like they had a profit. If they have an end capital of less than 1 lakh, that determines that they had a loss. But how do we determine? Because normally the shopkeepers also use the use it for personal expenses. Personal expenses are not differentiated between the official expenses. So we have to adjust for the drawings. How do we do that? We have to ascertain the capital at the beginning as well as at the end of the period. So normally if you see here, adjusted closing capital is what we have to ascertain. What is adjusted closing capital? What is the closing capital of the business? Add the drawings that has been taken during the year. Why we have to add drawings is because that is used for personal purpose. So, and what about to the beginning capital? Or so the formula normally what is being used is adjusted closing capital is equal to closing capital plus drawings minus additional capital what has been introduced. Additional capital is what the new investment that has been made by the business during the course of the year. And basis this information and basis the statement of affairs, we have to identify the profit or loss for the business. Basically, the adjusted closing capital minus opening capital is equal to profit or loss. And we can rewrite the formula like this: opening capital plus additional capital plus profit or loss minus drawings is equal to closing capital. It can still be written as profit or loss is equal to closing capital plus drawings minus additional capital minus opening capital. This determines the profit or loss. So while we before we go into the statement of affairs and then solve this challenge, I thought that it will be an introduction for you to understand how this has to be calculated. Let me know if you have any doubts or clarifications, and we can connect in the next class. Thank you, friends.